Dividend stock investing. These are the dividend stocks that I love right now in February of 2020. I just want to say, Trap Money Benny, 3M, you got me in my feelings. I am so excited about 3M. I bought more shares. I want to go through an extensive 3M dividend stock analysis in today's special Valentine's Day edition. I want to talk about some other stocks like Altria. Altria, are you riding? I own shares of Altria. I love Altria. I'll probably be buying more shares shortly. I'm going to go through an extensive dividend stock analysis of Altria. I want to talk about some other stocks today like IBM and the oil sector, Royal Dutch Shell as well. So get ready. This is an exciting special Valentine's Day edition of PPC Ian Dividend Investing for everyone. All right, everyone. So I want to get started. I'm going to do the 3M analysis first today. I spent a lot of time on this yesterday. I think you guys are really going to enjoy this. But before I do that, I have a few housekeeping items. There's going to be actually a bunch of housekeeping items that I kind of include throughout the video today. But I want to start with just a moment of silence for Kobe Bryant, Gigi Bryant, and for all of the people and the families affected by that helicopter crash from last weekend. Just such a tragic event. I just want to take, as a community, a moment of silence to reflect upon this horrible tragedy. Now, one of the things actually I was doing after the untimely passing of Kobe and reflecting, trying to process the meaning of this horrible thing, is I was just watching some interviews with Kobe. And one of the things that he had mentioned in one of his interviews is after his basketball career, he was going really heavy on the investing side of things. And the interviewer was asking him, "Hey, Mr. Bryant, what do you want to be remembered for?" And he was saying that he was almost viewing the investing as more exciting going forward for him than the basketball. And the reason that he was saying that is basically he was saying with basketball, he's winning one title at a time, and it's kind of active. It's like active income, if you will. You have to keep working, keep training, and you win, a season, you win the finals, but then you got to do it again the next year and the next year and the next year. But what he was saying, by contrast, investing is passive. It's passive income because once you build up the portfolio, it can live on forever. It can pass on cash flow. It can pass on returns for generations, if you will. And so for Kobe, he was kind of looking, he didn't say it in these words, but he was looking at basketball as active income and investing as passive income. Now, obviously, both have their merits. Both are amazing, and he has inspired us all through both of those. But I just thought it was worth bringing that up in today's video because what we're doing here as a dividend investing community, it is so fundamentally important, in my humble opinion, in that we're building passive income. We're building passive income, and there's an opportunity here as a dividend investor. This is how I'm looking at it, to look at the forever, to look at the long term, to look multi-generationally. And so I just thought it was really important to pause, take note. I'm not even a huge basketball fan, but I'll tell you, I grew up in Los Angeles in the 1990s, and I'll tell you, in the 1990s, late 1990s, man, Shaquille O'Neal, Kobe Bryant, Los Angeles Lakers, it had so much meaning for anyone in the city, whether you were a sports fan or not. And so with that untimely passing, it's honestly something I've been thinking about every day this last week, and I think I'll be thinking about it for quite some time. It's changed a lot of how I am looking at life right now, and I'm trying to harness that unfortunate incident, that tragic incident, as something that helps me improve as an investor, as a business person, as a father, as a family man, in life overall. And so I thought it was really important to just pause and take that moment there. Also, on a more positive note here, one of my subscribers, his wife reached out to me. This is Donny from Long Island. Donny, I want to just thank you, my friend, for being a loyal subscriber. From what I have heard, you are quite the investor. You are quite the expert when it comes to personal finance. Thank you for supporting the channel, for watching the channel, for being involved in the community. So your wife reached out, and I just wanted to say happy birthday, Donny. Your big birthday is coming up, 4-0. And so I just wanted to say happy birthday, my friend. Give a shout out and thank you. Thank you for being part of the community. And I can picture you rolling. I hope you have an amazing, amazing birthday. All right, everyone. So let's get to business. I want to share 3M right now on the screen. I bought more shares of 3M this week. I'm really excited. The earnings report came out. It wasn't that good. Numbers aren't that good. And so the stock started taking a tumble. And so I had the opportunity to buy more shares of 3M at $161.89. And so it has fallen quite a bit just in the last few days. We'll get to the earnings in a minute. I'll talk about the earnings, why they're lackluster, what analysts are thinking, so on and so forth. But first, I just want to share some of these numbers on the screen. And the analyst estimate this year for 2020 is $9.55. So that places the forward PE at 16.95. Now, we're going to get into this in a minute, but keep in mind, I don't believe that forward PE ratio includes the full value of 3M Company. I don't think it incorporates the full value of this stock because 3M is a cyclical company. It's an industrial company, and in a cyclical downturn, which they are in right now, in my humble opinion, it's like a spring. The earnings per share, it's like a spring. The spring is getting compressed now, but when they come out of the cyclical downturn, they head into a cyclical upturn, the earnings are going to skyrocket. Now, this may not be 5 years from now, or it might even be 10 years from now. It might be some time. I think I will have a lot of time to accumulate shares of 3M. I think it's going to be down for a while, which is good because I'm only at about 1/2 the size I want the thing to be. I have a lot longer to go because this is my number 10 favorite stock of all time. I have a lot of shares to add, but this is a huge, huge, huge takeaway for this video. For this sector, more so than any other sector in a cyclical downturn, remember that earnings per share for companies like 3M, it's kind of like a spring. And so in the short run, PE, forward PE, it looks kind of attractive at a almost 17, I would say fairly valued. But what it doesn't factor in is that when they come out of this cyclical downturn, earnings are just going to, spring is going to spring open. It's just going to skyrocket. We'll get more to this in a minute. So with 3M, the dividends are $5.76 per year. So the starting yield, it's a 3.56%. Not that exciting, but it is exciting because this is a dividend stock that grows the dividend over time. We'll get more to that in a minute. Payout ratio is 60%, but again, that's on compressed earnings. And 5-year dividend annual growth rate, compound annual growth rate is a 12.63, but the last dividend increase was a 5.88%. I think increases going forward, they're going to be somewhere in maybe the 4, 5, or 6% range. It's not going to be 12%, 13% anymore, but it will be at some point during the next cyclical upturn, which is probably going to be a while out for these guys, probably at least 5 years out, maybe even 10 years out. We will see. I'm willing to wait because I buy and hold forever, and that's what excites me about this thing now. I think I'm going to have some time to accumulate shares. So look at this. The price per share right now, as of yesterday, is $158 and change. The day after I bought it, the day the Dow Jones and the major indices tanked, they plummeted on worldwide concerns around that unfortunate virus. And boy, I'm already down 2%. I like this. So I want to share on the screen actually right now a tweet. I have a Twitter account. A lot of you follow me there. Bless you. I love engaging with the community on Twitter. I think this is one of my tweets that has had the most likes ever. And it's just something I wanted to remind myself of yesterday and remind others who may think the same way, that while most people dread a stock market downturn, they dread it. Just think about it. Traditional stock market investors, they invest, they buy low, they sell high, they want their account value to increase. By the time they retire, they sell off their investments, they use it to pay bills. But I'm different. I buy stocks. I look at it as a sunk cost. I never plan to sell. I solely rely on cash flow. And so when you have a mentality of a dividend investor, if the stock market goes down, it's a good thing because we know 3M at lower prices, I can buy more. My money will buy me more cash flow. It'll buy me more cash flow quicker. And so dividend investors, in an essence, we're hacking the system. We're thug life investors. We're doing things a little bit differently, or I would say a lot differently, whereas everyone else suffers somewhat when the market declines because account value is smaller, less money to retire off of. Dividend investors, our stream of dividends, which is what really matters, it's the same, if not increasing. And with the stock market down, we have the opportunity to buy shares cheaper and get more leverage on money being deployed. And I think going back to Mr. Bryant, this is what he was foreshadowing with the interview I watched about investing. It's about the long term. It's about multi-generational. The thing I love about dividend investing so much is there's nothing longer term. There's nothing more multi-generational than a well-built, well-constructed dividend stock portfolio, dividend stock strategy. And so I wanted to share that tweet with the whole community here to remind you I have a Twitter if you haven't checked it out, and also to just share a message that resonated with the community that I shared. And so I want to talk about this cyclical stuff now. So cyclically speaking, let's look at an upturn. If I look at the 2018, not that long ago, fiscal 2018 or calendar 2018, same thing for these guys. What did these guys earn? They earned $10.46. Well, we already know in 2020 what I just shared was $9.55. So it's already down about $1 in terms of earnings per share. The spring is getting compressed because we're in a cyclical downturn. We'll see this more in a minute. I know the company's kind of saying, hey, the things are going bad because of China. I know there's a lot of speculation about trade wars, this and that. I think trade wars, quite frankly, is just a scapegoat that a lot of companies use now. No, when I look at the deck that 3M provided me, which I'll share you in a minute, it looks to me like they're just seeing a broad-based downturn across the entire company. Now, some of that downturn is focused in aerospace. Makes sense because of Boeing. Some of it is focused in technology, which doesn't make as much sense to me. That's where maybe the trade war comes in a little bit, because it may be that firms in China that are manufacturing electronics are going with local suppliers now instead of 3M because of trade wars, etc. So there's a little bit of trade war in there. But I am seeing more or less broad-based decline across business segments at 3M. We'll talk about that in a minute. And across all of the different countries, quite frankly, that they engage with as well. And so for me, I see more of a cyclical downturn here than finger pointing at any one thing. And so, needless to say, though, the spring is getting compressed. It's getting compressed, but what's going to happen? There will be a cyclical upturn at some point. It will happen. It might not be for a while. I'm patient. I can wait. I don't care if 3M goes down to $100 a share. In fact, I would love that. I would love that. They would be in my feelings. And so basically even more than they are now. And so check this out, though. I just like to do a little modeling, like what could happen in the next cyclical upturn. Well, if the EPS goes back to 2018 levels, my PE ratio on cost on the purchase tranche that I just made at $161.89, it would be a 15. But what if it does better? What if it goes up to 11? My PE ratio on cost would be a 14.72 at $11 EPS. Let's say there's a big cyclical upturn. EPS goes to 12. I could totally see that. If that happened, PE on cost would be a 13.49. And so when people think, Ian, you're just buying 3M at a fair PE now. It's true. I am buying 3M at a fair PE in a cyclical downturn. But what these investors, I believe, are missing is the future. They're missing the future 5 years out, 10 years out. When the cyclical upturn happens, 3M, they're not going to be at $9 and change anymore in EPS. They're not going to see some marginal incremental improvements. No. There's going to be massive improvements. It's going to be quick. The spring is going to get compressed, and then it is going to just unleash. It is going to spring open, and earnings will hockey stick. That's my personal opinion on the matter. And when that happens, EPS it'll spring open. And so I have to look at PE for what's happening now. I have to do it because I don't know if maybe the future cyclical upturn, it'll never happen. Who knows? That's the bet I'm making. But I'm making the bet that it will happen. And if it does happen, I have to look at what's the PE ratio going to be on that cyclical upturn. And I think we're looking somewhere in the 13 to 15 range, which tells me 3M is a screaming buy right now. It's just a screaming buy. But I also think that investors in 3M are going to have to wait a very long time. I think we're just at the beginning of the cyclical downturn. I think the earnings will get compressed more, but the more they get compressed, the more they're going to revert in the upturn, in my humble opinion. So what I want to do also is talk about some free cash flow. I thought this was really interesting. And so, in fact, I want to pop on the screen right now a summary. This is just a summary of some of the things that they shared from their recent investor report from Q4 and for all of 2019, how they did. And let me just get that up there really quickly. Okay, so full year highlights, bunch of stuff here. Why is the stock down for starters? It's down because sales are down. They're down 1.5% when it's normalized for local organic currency. And GAAP EPS honestly is abysmal. On an adjusted basis, it's 9.10, and that, quite frankly, is what you just saw in my other analysis that I was sharing. Well, the analysts are expecting 9.55 because I'm looking at 2020, but for 2019, it was 9.10. So that's where you're seeing the $9 range. But that's adjusted. When you look at GAAP EPS, it's 7.81. And why is it 7.81? Significant litigation-related charges of $1.01 per share. I want to talk about this in a minute. I'm going to plant the seed now. Major takeaway. One of the most important things with this channel is to keep all of our eyes wide open, especially mine. Keep me honest with myself. I look at adjusted earnings per share, but a lot of wise accountants on the channel have told me, Ian, you should look at GAAP because it's hard to fool with GAAP. And if you look at GAAP at 7.81, let's just do that. If I do 7.81, what does it do? It puts the PE up at a 20, 21. So what's the PE on a GAAP basis of 3M now? It's a 21. What's the PE right now on 3M on an adjusted basis looking at 2020 analyst estimates? It's a 16.95. The GAAP earnings, the reason they're low is because of litigation. The reason 3M adjusts them is they're saying, hey, this litigation stuff, it's short term. It's not going to be forever. Litigation, it's not going to be around forever. But, gosh, I don't want to make too much political commentary here, but one of the trends that I see with the stock market, with companies, is with big companies, there's more of this litigation. And a lot of companies, they're adjusting their EPS. They're saying it's a one-off thing, this and that, look at adjusted. But I want to quickly toggle between screens here. I'm going to pop something else on the screen because I'm talking about it right now. This is really, really important. And so what I'm popping on the screen right now, and on my own computer, I'm trying to toggle between screens, so please bear with me, is this. In their investor deck for Q4, there are footnotes. And these footnotes talk about the litigation. And so one takeaway, sub-takeaway of this takeaway is look at the footnotes, everyone. Look at the fine print. That's one of the things I want to impart on this channel. There's a lot of content on the internet that just goes high level, says, hey, I feel good about this stock for XYZ reason. I do that too, but what I say separates my strategy is I like to really dig into the details. I feel that it gives me an edge in my own dividend stock investing. And if nothing else, it allows me to keep my eyes wide open. And I think some of this litigation, maybe it is the new normal, because check out these footnotes. It says in 2019, the company recorded significant litigation-related charges of $762 million, $590 million after tax. And it's related to certain perfluorinated compounds. Basically, what it's related to is some environmental stuff. That's my understanding, is there's some environmental stuff that 3M is dealing with, and it's costing them a lot of money. Let's look at this, though. It says in 2018, this ain't 2019, this is 2018, 3M recorded significant litigation-related charges of $897 million, and that was $770 million after tax, again, related to PFAS matters. Oh my gosh. And so you can read all the fine print here, but the takeaway is this is on slide 22 of their deck, of their footnotes, and what they're saying is massive, massive, massive litigation charges. And they're not only speaking of them from 2019, but they're speaking of them from 2018. And I draw parallels because I see this for other companies that I own as well. And so the question is, Ian, Should I be looking at the adjusted EPS that they're putting forth? And the reason they're adjusting, I believe, is they're saying, oh, the litigation, it's a one-time thing. Or is the litigation the new normal? Is it the new normal? And looking in the future, what's going to happen if a more, say, socialistic style government comes to fruition? I don't know if it will or not. I don't want to get too political here and tell you one thing or another. I'm just saying, what if it happens? You start thinking, oh, does it pave the way for this type of stuff, broad-based, becoming the new normal? And then you start thinking, oh, should I be looking at that adjusted EPS, and is the PE ratio really a 16.95, or is it a 21? And is that the new normal? Yeah, they're adjusting it, but the adjusted I shouldn't look at. I should look at the gap, like a lot of my accountants are telling me, friends on this channel from this amazing community, 50,000 of us strong. And so I don't know which way is best, but what I'm trying to say is I look at both ways because it keeps my eyes open. And so I know right now I'm buying 3M at worst at a 21 PE. But let me tell you, philosophically, then I start thinking, okay, let's say this stuff is a new normal. Let's say someone like a Bernie gets elected. Who knows? Things change. What other options do I have? I guess that's the way I also look at it. The stock market, dividend stocks still are the best alternative in my humble opinion, regardless of what happens out there, socially speaking, politically speaking, etc. And so I still default to dividend stocks. I still default to high quality dividend stocks, dividend kings like 3M. I still default to all of that, but I have to keep my eyes wide open, and the value, it may or may not be what it appears to be, because some of these one-time things, it may not be one time. And so check this out, though. What does give me comfort? I'm going to pop on the screen again the highlights from their Q4 press release. And something that does give me a lot of comfort is there's a line down here that says operating cash flow. Operating cash flow of $7.1 billion and free cash flow of $5.4 billion is an all-time record. It's up 10% year on year with free cash flow conversion of 118%. Free cash flow conversion is probably higher than what it'll be in the future. That's the function of free cash flow as compared to net earnings. And it's higher now because net earnings on a GAAP basis are wacky because of these charges, this and that. So the conversion, who knows, it may not always be that high. But needless to say, the takeaway here is free cash flow is at a record. And so, yes, is the PE really a 16.95 or 21? It could be debated. GAAP EPS or adjusted? It could be debated. Is the litigation the new normal? It could be debated. I look at it all. But ultimately, where do my dividends come from? They come from free cash flow. And so to see, despite this challenging market, this challenging cyclical compression, this challenging everything right now for 3M. They got Boeing going against them. Yeah, maybe the trade war is affecting them a little, although I think it becomes too much of a scapegoat. I'm just tired of hearing about the trade war. And so, that being said, despite all of that, record, best free cash flow they've ever seen. That's what they said. Best, all-time record. And they returned $4.7 billion to shareholders in dividends and repurchases. So I want to look at that for a minute. Let's look at free cash flow. I'm going to pop this back on the screen right now. And let's see, this is some analysis that I did, and it shows, yeah, free cash flow, it's $5.4 billion. It's an all-time record. It's up 10% year on year. By the way, free cash flow, it's what's left after capital expenditures, and it adjusts for GAAP weirdness. It adjusts for changes in working capital, and it's what's left, really, the real cash flow that could be used to pay dividends. And so with dividends and repurchases, they used $4.7 billion of the $5.4 billion. So what's left of that free cash flow? It's about $0.7 billion. On a free cash flow basis, they're covering the dividend and repurchases handsomely. They got money left. They're doing just fine. And so for me, I'll tell you, what are my takeaways on 3M right now? My big takeaways are that I'm going to be holding for 20 plus years. Longer than that, but given that that's where I'm going, I think it's going to be down for a while. I think the cyclical compression could be for a while. That's good. I have time to accumulate the other half of my position, hopefully at lower share prices than it is now, because once I put my money in, that money, I look at it as being gone, and I just look at stream of cash flow. Lower share price, more cash flow. And I think that this will be a good opportunity for me. Now, if my time frame were shorter, say hypothetically I were investing for the next 5 years or 10 years, is 3M a good place probably to look? Maybe if I needed cash flow now, for example. No, I'd probably be looking at other alternatives like Altria, which I'll talk about in a minute. There's other stocks. 3M right here, quite frankly, it is going to be a long game. I'm just telling you, long game in my opinion. Longer game than pretty much anything else I've been talking about recently, and I'm okay with that. I love that because it allows me just to think a lot more strategically, long term. And so before I move on to 3M, I want to share a few more things. I'm going to pop on the screen some more screenshots from their recent report. And so first thing I want to show is this is a slide from 3M from their investor presentation, and it shows the sales recap. And so you can see here stuff on the left. I think I've already talked about a lot of that. This is just from Q4, though, I guess not the full year. But you could see sales are down on an organic local currency basis. Not good. Cyclical downturn, spring compression. But check this out. Everyone's saying, oh, it's China, this and that. I'm so tired of the blame game on China, trade wars, this and that. I think it's a scapegoat. Look at local, on the right side of this slide, organic local currency growth by area. U.S. is down. Asia Pacific is down. Within Asia Pacific, Japan and China, Japan's down. Actually, China's up. Okay. Europe, Middle East, Africa, EMEA, down 2.7%. Canada's up. Mexico's down. Brazil's up. So you can see here, is this a China thing? Maybe there's some of it there, but I'm just saying I'm seeing a broad-based decline across the board. Yeah, some countries are up, but it's a mixed bag, and I'm seeing a decline in the U.S. So I think it's a cyclical compression here of an industrial cyclical company, in my humble opinion. Let's look at more stuff. This is a good example here, and I got some arrows on this chart as well. This is again, from their investor deck, this is the Q4 sales by division. I'm not going to go through all of these, but if you look at stuff, like just look at them, abrasives, it's down. It went from, I think this is in millions, 362 million to 335. Automotive market, it's down, 336 to 314. Closure and masking systems, it's down, 304 to 276. So on and so forth. Everything down. Maybe at least roofing granules is up. But, everything, personal safety, it's down, 861 million to 852. Okay. And that's, look, to be fair, that's all within the safety and industrial business group. But this is net sales, I believe, by the way, that's not adjusted for local currency. And so that's why when you add up these numbers, you look at them versus other slides, etc. I was thinking, why don't these numbers match others? It's because these are not in local normalized currency. I think it's just raw net sales in US dollars. Now, check this out, though. If I go to the next kind of tranche of divisions, including transportation and electronics business group, you see some big ones here, like automotive and aerospace. It's way down, 499 to 457. So they're losing, 40 million there just in Q4. I think that's Boeing, everyone. That's what I think. And so one of my commentators here from years ago, my man, living life. I hope you're doing well, buddy. I haven't heard from you for a while. But he was saying he thought there was some kind of relationship between Boeing and 3M. And I agree. I think that's probably what's happening here. You go to Boeing, you go to their preferred partners on their website, 3M is always listed there. And so 3M supplies to Boeing. Boeing's facing troubles. Boeing is cutting costs, production probably slowing down, etc. That hurts them. Check this out, though. Electronics, you got a big old drop here. 1014. So 1 billion down to 951 million. So they lost about 60 some odd million dollars here just in Q4. Maybe that's trade wars. And so, yeah, there is some truth to trade wars, etc. It may just be cyclical as well. I don't know. But you look at other groups like healthcare, you have some brightness there. And so that's nice to see. There's some brightness in the healthcare group, which is on the right-hand side of this slide, for the total healthcare business group. And consumer healthcare, or consumer business group, it's doing okay. It's basically flat here. And so that being said, all I'm trying to say when I look at this, especially across safety and industrial and transportation electronics, the decline, it's pretty broad. Yeah, you have some concentration in electronics and automotive, but it's a broad-based decline. And again, what I'm trying to paint the picture is there's one message that the media is sharing: China, China, China. I think there's another message here that we looked at the geo stuff on the last slide. We look at the business groups on this slide. I'm just seeing a compression. I'm saying cyclical downturn, cyclical downturn. You got me in my feelings though, 3M, and I'm going to buy more shares. I'm going to have a long time to do so, in my humble opinion. I'm going to have a long time to do so. And so let me see if there's anything else. This slide that I'm going to share now, it's more or less of a summary of the last slide. So I'm going to pop this on the screen. It's the Q4 business group performance. And it just goes to show this one's organic growth. This is why I'm sharing this one. The last one, I think it wasn't organic. It was just raw dollars. When you look at things organically, healthcare doesn't even look as good as it did on the last slide. You see your broad-based decline. Safety and industrials down 2.8%, 5.9% for transportation and electronics, minus 0.2% for healthcare. Consumers up marginally. And so the picture I'm painting again and again and again is, I think it's a cyclical downturn, and I think we're just getting started. Buckle your seatbelts, get ready. There's probably more value ahead, but I don't know where stocks are going, so I always dollar cost average in, keeps my head in the game, allows me to optimize my weighted average purchase price, keeps me in the game, and allows me just to buy cash flow. Because who knows? I'm already using some of my cash flow. Maybe I wake up tomorrow and I decide to use more of it. More stocks I can buy sooner, more cash flow I get now, which is when I need it. So that's 3M, everyone. I'd be curious, what do you think about 3M? Do you like it now? Do you not like it? Do you think it's a long game, short game? For me, super, super long game. And so I'm going to move on to the next segment, which is Altria. But before I do that, I got some more housekeeping. And so we're talking about Drake. We're talking about that song. And one of my favorite things, by the way, about that song, In My Feelings, is that he gives respect to the producer, Trap Money Benny. And Trap Money Benny, based on my reading, before I knew too much about it, I just looked it up on the internet and I learned a little bit more about who Trap Money Benny is. My understanding is, before this song, he wasn't a big star. He wasn't a big time producer. This is someone who literally reached out to Drake's team years ago. And my understanding is, at the time, nothing worked out. A lot of years passed. He kept producing beats. And then he decided one day, you know what? I'm not going to give up. I'm going to give it another try. I'm going to reach out to Drake again. And so he sent another sample to, I think, someone on Drake's team. The person on Drake's team shared it with Drake. Drake liked it. He went back. They collaborated. The rest is history. And so the story with Trap Money Benny that I love so much is that this is someone who had persistence. He didn't give up, just like me. 3M. I have persistence. I'm going to keep buying dividend stocks. It's hard at times. The ego can take a hit. Look, I do tweets like the one I shared before. And everyone's happy as dividend investors when the stock market's crashing. But I know you all. You got the ego like I do. You see your portfolio value declining. Even if it's not conscious, on a subconscious level, it affects you a little bit. Used to affect me more, doesn't affect me as much now. But the idea is, this ain't easy, just like Trap Money Benny. It's not easy. You just have to keep having persistence. And eventually, the hindsight I have now is I have such big built-in gains because my portfolio has gone up so much. And I've enough cash flow now where it's kind of like, hey, been there, done that. I got that built-in comfort. But still, it's not easy. You got to have the persistence. You got to keep pushing. And that's something I really respect about Trap Money Benny. But the other reason I want to bring him up is I have my own Trap Money Benny. His name is Bernie. And so shout out to Bernie. I want to basically throw something out there. Some of you have commented, Ian, your thumbnails are really good. Ian, your introduction is really good. Your logo. I got my man Bernie. He's my homie. He's my friend. He's my graphic designer. And so I was talking to Bernie the other day, and he's interested in expanding his business. He's interested in taking on more clients. He's interested in growing, in being the best he can be as a graphic designer, as a web producer, as a videographer, photographer. He does it all. He'll do anything related to marketing and creative. And so what I want to say is, if you're out there, you're watching these videos, I got a lot of people, 50,000 strong. Bless you all. God bless you all. I love you all. If you need a graphic designer, reach out to me. Shoot me a message here on YouTube or on social media, on Twitter, for example. Direct message me on Twitter is one fabulous way to reach me. Go ahead and do that, or on Instagram, direct message me. Let me know if you're interested, because if you are, I can connect you with Bernie. He would like to talk to you. He's affordable. He's very affordable. He does top-notch work, as you've seen here on my channel. I just want to throw that out there. Please reach out if you need a graphic designer, and I will hook you up with my homie. Anyway, I want to move on now. I want to move on to the next segment, and this is Altria, another stock that is in my feelings. And I love saying that. I love saying that because so many people out there, we talk about the socialistic type stuff, this and that. They don't like it. Makes me like it more. All right, everyone. So I want to talk about Altria. I've got a lot to cover. I think with Altria, I'm going to start with some subjective stuff. So I'm going to share it on the screen. I'm going to toggle on my computer here. Bear with me. I'm going to share some subjective stuff. I'm probably going to be buying more Altria. I loved their earnings. Market didn't like it. Stock tanked, just like 3M. But I like it. And so I want to talk about the subjective stuff here. First and foremost, federal vape ban. Okay, I just want to give a summary. Back in January, we're in February now, frugal February, y'all. I'm going to be doing a video on that shortly with my wife. It's going to be really exciting. We're taking on Canna Campbell, Sugar Mama TV's challenge. One of my favorite YouTubers. We're taking on her challenge to save as much money as possible in February. Get ready. We'll talk about that later this month, what we're doing. But anyways, it's February. But back in January, there was a federal vape ban enacted by the FDA in collaboration with President Trump. And I just want to say thank you, President Trump and FDA. You guys, I think, struck the right middle ground on the ban. You didn't go too aggressive, which I think is important. What I also think is important is all the vape shops. They got together, they formed a coalition, and they went heavy on the lobbying. And I just want to, if you're in that industry and you're watching the channel, thank you, guys. Thank you for forming that coalition and lobbying for yourselves and quite frankly, for influencing policy, because the policy, in my opinion, turned out right. Anyways, check this out. There's no more flavored cartridges allowed, but menthol flavor and traditional flavors are allowed. There's though flavored liquid is sold still for open tank systems. And so this is what the lobby allowed. The lobby basically said you can't sell these flavored cartridges, but if you have an open tank system, you can buy flavored liquid. And so there's these nuances. Like I said, it's not just putting the entire industry under. I think it's an exciting middle ground. And so I'm just saying good job on the shops for mobilizing, and good on President Trump and the FDA. Thank you. And in my opinion, there's local bans in certain cities, this and that. That's irrelevant, because if a city bans the product, the consumer just goes to the next city over, buys it, brings it back. And so that's how I would say most consumers probably operate who are using these products. And so anyways, I wanted to start with that backdrop. Is the federal ban some huge debilitating thing that is going to crush an entire industry? No. And so I wanted to start with that picture. Quite frankly, is this stuff a meaningful percentage of Altria's revenue? No. So even if the whole thing did go under, it wouldn't hurt Altria that much. It would hurt the fact that they paid a ton of money to acquire a percentage in Juul. We'll talk about that in a minute. They've already written off a lot of that, so we'll talk more about that in a minute. But would it hurt Altria's day-to-day if the whole industry went other than proving that they made a horrible use of capital and made a bad acquisition? No, it wouldn't. And so People talk like it is, though, and that's why the stock is down. And they're also down, quite frankly, because of fears of litigation, just like with 3M. We'll talk about that in a minute. Is that the new normal? We'll see. And so anyways, I just want to give some background on what happened with Juul. They bought Juul for $12.8 billion. They wrote down another $4.1 billion impairment charge. So what happens when one company acquires another? If the company pays higher than what the book value is of the company they're acquiring, that gets carried as goodwill on the balance sheet. So Altria has all this goodwill on the balance sheet related to Juul. Well, they've already written down $8.6 billion of that goodwill in terms of impairment charges. They're basically saying $8.6 billion of the $12.8 billion that they paid for this thing, they don't see the value anymore. It's gone. Keep in mind it's pre-tax and it's non-cash, so they're not losing any cash here, but what they're saying is basically they overpaid for this thing. They shouldn't be carrying it on the books for the amount, in terms of the assets that it's being carried at. That goodwill isn't worth what they thought it was. And so, again, they're not losing any cash yet. What else? The investment is down. The total investment that's left in Juul, if you take the $12.8 billion and you subtract out what's already been written off as impairment, $4.2 billion is what's left. And so they vastly overpaid. They basically wasted away valuable shareholder money. But maybe that's not the case. We'll get maybe to that a little bit later. They're restructuring their agreement with Juul as well. It's in favor of Altria. It's really in favor of Altria. And there's a lot of clauses in there that are going to benefit these guys. And so I'm just going to give a summary right now because this is the topic that's on everyone's mind. I know I'm not being very eloquent here. I'm doing my best. It's Saturday morning, was up late working on this Friday night. Bless my wife for taking care of the kids right now so I can get this video out for all of you, a Valentine's Day special. Here's where I stand as it pertains to Juul and to this vape stuff. Basically, Altria vastly overpaid for this thing. They already wasted away at least $8.6 billion of shareholder money that could have just been returned to us as a dividend. Oh well, it happens. And now, I don't take that lightly, but what I'm saying is the strength of this company allows them to do this. If most other companies around the world did something like this, they may be out of business. Altria can do this and they can weather the storm. That's how strong Altria is. That's why Altria is in my feelings. Also, though, the way I see this is, I don't know precisely the game of chess that's being played here, but I think it's being played. Altria is restructuring their agreement with Juul. Altria's got their own people now working at Juul. Altria is striking new agreements with Juul that allows Altria just to produce their own product. One way or another, and we got the backdrop of the federal ban, which is actually good. Bless everyone that made this work out for once. But, administrations change. Things in the future are more socialistic. Who knows if it'll be as favorable. But what I'm saying here is you got the backdrop. I think this stuff is here to stay. Yes, Juul may get in a lot of trouble. Altria may be in further trouble because they invested and now maybe they become liable for lawsuits that are coming their way. That's the reason for the impairment charges. It's because of the risk that Altria believes may be on the way with lawsuits. But there's a silver lining. The silver lining is, honestly, I see one of two things happening, if not both. One day, Altria may own the entire Juul for pennies on the dollar and command the entire market. That's one option. The other option is Altria is so underwater on this thing that it allows them, and they learned so much through all this, it allows them to create their own product, bring to market, and command the market. Getting into a new industry is tough. It's a new industry. It's unproven. There's a lot of skepticism. There's a lot of hatred for it. It's in my feelings, but it's not in everyone's feelings. And so there's been a big cost to do that. But I look at the silver lining long term. One way or another, through all of this, Altria is going to command this thing. And look, don't forget, these guys went through the master settlement agreement back in the day. Altria and others have weathered this storm before. And so I honestly think there's a silver lining here. I think it will all work out. I think it's a game of chess that's playing into Altria's favor. We shall see. I will certainly be buying more shares in the next week or two. if the share price stays this low. I like Altria at these levels. Okay, so I want to talk about some of the numbers now. The interesting thing is, despite all this drama and everyone's saying that this is a company on the decline, not really. Years 2020 through 2022, they're guiding that they will grow. Their earnings, I believe, they're guiding for a 4 to 7% growth per year on average. It's down slightly by 1 percentage point, the range, due to Joule. And Q4, let's look at this. Adjusted diluted EPS, it was up 7.4% year over year. It's down on paper. People are going to go to Yahoo Finance and they're going to tell me, Ian, they're losing money. They can't even pay the dividend. Not the case. They took a non-cash impairment charge, everyone. Non-cash. And so you don't look at the impairment charge. This is one case where I think adjusted diluted makes sense. Adjusted EPS makes sense to look at. You look at adjusted, they're earning $1.02. It's up 7%, 7.4% year over year. And we look at 2019. What did they earn? $4.22. It's up 5.8% year over year. The media would want you to think companies going out of business. The media would want you to think they're doing the wrong thing. They're somehow doing something awful. I don't agree with the media here. I just don't. And I see a company that's growing. I see a company that's providing lower risk solutions in the marketplace that they're in. They're in my feelings. And so net revenues, mind you, were down 1.8% year over year. So the company is shrinking in terms of revenue, but earnings, which is how we pay for dividends, are growing. And so they have some positive stuff too with their heated product, IQOS, and with an acquisition in a chewables market, oral pouches called On. Good stuff, Altria. So I want to move over and I want to share some analysis in Excel. And so check this out. Price per share is now 47 and change. Analysts are expecting about 6% growth, so right in that range that Altria gave them for 2020. 2020 EPS should come in around 444 on an adjusted basis, not taking into any more non-cash impairment charges. Forward PE is a 10. Oh, man. Oh, my goodness. 10! And so we're looking at 3M. At best, even when the spring unleashes, I'm buying the thing at a forward 13, looking 10 years out. I'm buying Altria right now at a 10. I love that. And dividend yield, it's gotten above 7% again. And so I need cash flow now. Right now, I want to pay bills with cash flow. This is a stock I'm looking at. I love it. Now, mind you, I've bought in a lot lower. The yield on cost on my original tranche is over 20% now, but I'm still willing to buy it at a 7%. I don't mind averaging up. Payout ratio is now 76%. Now, mind you, they said they're going to target an 80% payout ratio, and so gives them room to increase the dividend. If they target an 80% payout ratio, the dividend per year goes up to a $3.56. It's about a 6% increase, and if that happens, the yield will be 7.5%. So what this analysis shows you all is, starting dividend now is about a 7. But in my opinion, sometime in 2020 or 2021, the dividend, in my opinion, should get up to about a 7.5% yield on cost on current price of 47. Dividend increase, last one was 5%, 10 years, 10%. I think the dividend increases going forward probably be in the 5 or 6% range, which will get us to that 7.5% pretty soon. And so I really like Altria here. I am buying more Altria soon. I can't wait to buy Altria. That's what I think about it all. That's what I think. And so the only negative thing out of all of this is just the massive debt now they've incurred on their balance sheet that basically is for nothing in the worst case. In the best case, like I said before, there's a silver lining to it and they end up owning all of Joule, or they end up doing their own version of Joule and making it happen. Thankfully, all of this has allowed them to work with President Trump, work with the FDA, get this federal ban that works, I think, for all stakeholders. It's the right ban. It's not too aggressive. And so I'm thankful for that. All right. I want to move on really quickly here. We're getting towards the end of the video now. But I do want to share a few more stocks that are on my mind, in my feelings. Let's talk about another stock that I just bought recently that's already gone up a lot. And I'm buying more because the PE is at a 10. I want to talk about IBM, everyone. Check this out. I'm going to put it on the screen right now. IBM is up. Why is it up? They announced a new CEO. His name is Arvind Krishna. He is the guy. He is the mastermind that is behind the Red Hat acquisition, and now he is replacing Ginny as the CEO of the company, and the stock rallied on this news because they believe that he's a technology guy. He's a technical person, engineering background, who masterminded the whole Red Hat thing, and he believes, the market believes, that he will drive forth the future of this company quicker perhaps than the existing leadership. And so IBM right now is trading at a forward PE of 10, and it's I think it's just at the beginning of a growth cycle. Now, I've been saying this for a while, kind of like a 3M. It's going to be a long-term turnaround play. But again, this is something I'm looking out 10 years, 20 years. It's going to happen, everyone. And I think Arvind Krishna is the right man to make this happen. Usually, I don't place too much weight on leadership, especially for more traditional companies, say like a 3M, for example. But when it comes to technology, leadership is important, real important, because things are changing so quickly. And I don't want to downplay 3M's a tech company too, but IBM pure play tech. Having the right leadership there will catapult IBM to the next level quicker. So I'm excited about that. And like I said, 2020 forward PE is a 10, dividend yield is a 4.51, payout ratio is a healthy 48%. And mind you, all these stats are on the price per share that's current, not the price I just bought, which was in the 130s. But I'm still willing to buy in the 140s for sure. 5-year compound annual growth rate on that dividend is an 8. Last one was a 3% though. And I talked about this in a recent video. The reason the dividend's growing slower now is they're going to pay down debt. And they already are. Since the Red Hat acquisition, they've already paid down a ton of debt. And so I like what's happening with IBM here. I don't want to talk about it too much because I just literally talked about it in a recent video. I'll link to it in the description below if you want to check it out. I talked about it at length. I love this thing. It's in my feelings, but I want to point it out again because the topic of today's video are the dividend stocks I love right now. And IBM is up there. It is up in the list for February 2020. I'm thinking, which stocks do I buy in February? I'm going to start probably with Altria. 3M, I'll probably buy some more. IBM's up there too. I'd say IBM is almost number 2 right behind Altria. I love IBM. The reason I'm a little more hesitant on 3M is I just bought 3M, and so I want to cycle and buy a few other things before I buy more 3M. It's just how I am. I like to mix it up. So I want to close out with an oil stock. Price of oil is down. Unfortunately, on the global concerns about the virus, basically this stock is down. Price of oil is plummeting down. I think oil now is in the low 50s. It's had a 1 month drop pretty aggressively, and we all know oil companies are only so good as the price of oil. When oil goes down, these companies take a tumble, but what I've always experienced in the past is oil typically will rebound. And so also Royal Dutch Shell, this is the example I'm using today. They didn't have the best earnings. So one of the things that analysts were writing about is that the proven reserves of oil they have, it's lower and lower than they would have liked to see. It's certainly not growing for them. And so I've talked about this a lot in another recent video, which I'll link to in the description below. I don't want to go into the oil segment right now, but the one imparting wisdom I want to share, this is like IBM. IBM, the imparting wisdom is leadership changes matter for tech. I like the new leadership, gives me even more confidence to buy more. That's a takeaway on IBM. Oil, the takeaway is when the price of oil is down and oil stocks are plummeting and starting yields like Royal Dutch Shell are up at a 7.21%, that's when I always love buying oil stocks. And so I'm going to be buying more oil stocks in February, depending on how much money I have available to buy. First priority is Altria. Second priority is probably IBM. Third, oil. Fourth, 3M. Hopefully, I end up buying all of them this month. Maybe something else as well. We will see. But the point here is earnings were kind of bad because price of oil has been fluctuating. Price of oil is even worse now. Oil companies are tanking right now. And so all my experience tells me is that's a little scary because the oil companies don't control the price of this commodity. The price of this commodity is controlled by the market, and the market is not valuing it very high now because of worldwide health concerns. Now, in my opinion, is, at least for me, this is historically when I've always thrived buying oil companies at these types of prices. So I'm excited about Royal Dutch Shell. And I've done a video on oil recently. In my opinion, oil is not going away. I don't want to rehash that. Check out the description below. I did a very in-depth analysis of that all. Now, of course, my heart goes out to anyone affected by the health issues that are out there, who knows someone whose family, who personally is affected. My heart goes out, and I am praying that some of the companies I own that are in the medical space, in the pharmaceutical space, can develop cures and remedies that will help with this stuff, because it's not good. And so I'm not trying to make light of a horrible situation by any means, And so I have a big heart for everyone out there. All right, everyone, that is the video today. I want to share one other kind of, maybe we close on a positive note here. Check this out, another tweet that I want to share with you. I own a company called Norfolk Southern, and the reason that I'm bringing this up right now on the screen is so many people out there believe that dividend investing is boring old stocks. They can't beat the market. Boring old stocks, they're not going anywhere. Ian, you just buy it for the dividend. Here's a perfect example. I buy Norfolk Southern in 2013, which is a railroad, for $74. Now, as of the time I did this tweet, is at $216. I'm up 192% on that tranche. 5% dividend yield on cost. Comparable period, S&P is only up 97%. The takeaway here is, for investors, even in boring, quote unquote boring, I don't find it boring. I love the railroad. I find it more exciting than most things. But the takeaway here is that dividend investing works. It works well. It's exciting. And even with the railroad company, I can beat the S&P 500. This is another way to look at it, because I think there's so much misinformation out there about dividend investing. All right, everyone. I love you all. Thank you for watching today. Happy Valentine's Day. Before I leave today, in terms of full disclosure, I am long the stocks mentioned today. I am long 3M, ticker symbol MMM, Altria, ticker symbol MO, IBM, ticker symbol IBM, Royal Dutch Shell, ticker symbol RDS-A, and good old Norfolk Southern, ticker symbol NSC. I own all of those stocks in my personal dividend stock portfolio. Also, very important to mention, a friendly disclaimer: I'm not a licensed investment advisor. Today's video is not investment advice. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey here on YouTube for fun and entertainment. And this is so important to mention. Our stock market is hovering around all-time highs. There's risk. There's a lot of risk with stock market investing, and so everyone needs to evaluate their own personal situation, proceed with caution, all of that good stuff. Happy Valentine's Day, everyone. I'll see you in the next dividend investing video.